Hello and welcome to the last episode of Spy Trader Now video for 2022. This is the year-end review of where we landed. And we pretty much are very close to where we were at last week, which is our portfolio is up 21% year to date, and the S&P buy and hold investor is down 19% year to date. Here's the exact figures right here for our positions on where we are landed. Spy Trader Now, we do a 3-position portfolio where we either have shares of the S&P 500 and we buy the ETF called SPY, or we'll have options and we'll do both calls and puts, or we're in cash. Currently, we are 100% invested in cash, and that is where we are at right now. We made one trade during the week, and I'll show you that trade as we go through the presentation. We start off the beginning of the year at $100,000, and we are currently at $121,051.96. So we have a 21% return on investment year to date. Well, for the calendar year, because the year is now over. So that's where we're at. Okay, so at Spy Trader Now, where we do not buy and hold, we buy, sell, and trade the S&P 500. So 12/31/22, we're up 21%. This is a chart for a one-year graph of the S&P 500, and I'll go through all the charts later on in the presentation. And we did, I actually didn't put my last trade on here, but we did go to cash on 12/9, and then I made another trade during the week here, and I'll show you that trade in 1 second. Okay, so for the week, the S&P 500 lost 0.13%. This is a weekly chart. Each one of these candlesticks represents 1 week of data. We're going back 5 years on this chart. In the last week, the S&P only lost 0.13%. Basically, it went nowhere. Now, in last week's video, I explained how this candle, not the current candle, but the one to the left of it, so that's 2 weeks ago, produced a spinning top. So that spinning top, I explained how that usually represents a change of direction. In this case, the change of direction was from downward momentum to sideways momentum. Okay, so here's that trade I was telling you about. On 12/27/22, we did a cash secured put contract. It was about 60% of the portfolio, and we ended up buying, we ended up doing the cash secured put. So we actually sold a put. We sold the 375 strike with the expiration date of 12/30/22. So that was on Friday, it expired. And because the S&P 500 SPY closed at a price higher than 375. It closed, not sure actually what number it closed at, but I know it was higher than 375. So that's why we didn't get exercised, so we don't own the shares. So we just increased our portfolio of by $163.80. That was on our last trade of the year. So SpyTraderNow.com is where you can go to my website. You can sign up for real-time trade alerts. And also, if you want to see this is just a snippet of my trades that I made in 2022, but if you want to see all my trades going back 3 years, you can head over to SpyTraderNow.com. There'll be links in the description for you to link directly to this website. And if you haven't done so already, please go ahead and smash that like button, ring that bell to be notified, and do me a solid and give me a thumbs up for this video to help me promote it. Thank you. Our portfolio year to date, I know this is not 100% accurate because I didn't start tracking this until right about here, about a month ago. And so this is where our portfolio is at right now, looking at it on a chart graph from next year, because we're going to start this off at $100,000 in 2023. We're going to start off here and we'll see how well the portfolio does in 2023, starting from scratch. And this is good data here for the S&P 500. If you were a buy and hold investor, this is how your portfolio would have done being a buy and hold investor. So you can see how the trajectory of how it traded during the year. And here's the two things combined, not 100% accurate data. I know that this is not accurate here. It will be moving forward and when we do our 2023 chart. But for right now, you can see where the S&P 500 was down over here. This is on a percentage basis, and how SPY Trader Now's portfolio is up over here. So you can see the nice differential going across there. Hopefully, we're going to have that same nice spread differential going into 2023, but only time will tell. Okay, so talking about the Fed, nothing new from last week's data. We're still at our current stance of 4.25 to 4.5% is the Fed interest rate level currently. And we have a target of 5 to 5.5 for 2023. There's Jerome Powell, the Fed chair. The FOMC meetings in January 31st, February 1st, we're going to have our first Fed meeting. We have an expectation that we're going to raise 25 to 50 basis points. That's what the expectation is that I expect. Well, only time will tell, but I'm pretty sure we're going to have a rate increase on this date. Bankrate.com did not update their website, so I don't have this week's data. I just copied it over from last week, but I still expect us to have an inverted yield curve, meaning that the short-term treasury rates have a higher yield than the longer-term 10-year treasury rate. So we have, and that is not favorable for the stock market to have an inverted yield curve. That's why we're red, and yes, that's not good for the stock market. Also, we have a rising interest rate. 1 year ago, the 10-year yield was 1.48. Now it's 3.69. So we have two things against us. We have a rising interest rate and an inverted yield curve. Definitely, that looks like a predecessor telling you that we are going to have a recession in 2023. Okay, now looking at the monthly chart for the S&P 500, each one of these candlesticks represents 1 month of data. Here's the last month of December. This is the data that you see here. This is where we opened, and this is where we closed for the month. The S&P 500 lost 5.76% for the month of December. Even though on a seasonality basis, we should have closed higher. There was a 70% probability that in December, we were going to close higher than when we opened. Now, even though you had a 70% probability, again, not a guarantee, just a 70% odds, the odds did not work in our favor for December of this year, 2022. Now, in January of 2023, the seasonality chart is telling you that we have a 45% probability that we will close higher than we opened the month of January in 2023, meaning that you have a 55% probability that it's going to close lower. But look what happened over here in December. Even though the odds were in your favor that you were going to have a positive month for the month of December, the month was still negative by 5.76%. Just this goes to show you that every data point that you take when it comes to the stock market, you have to take it with a grain of salt because there are no guarantees on exactly the outcome of how things will play out. Now, we're looking at a monthly chart for the S&P 500, and we're going back, I believe, 20 years. You can see over here that we hit a resistance line top and we're starting to come down. And this is where we're at in the thumbnail. You can see where it hit that resistance line, came through all those moving averages, and has crossed below it and is heading down. The MACD is still negative where the black line is below the signal line, but the histogram is showing that it's going in the opposite direction, meaning that we should reach a bottom soon, although we have not done so. The slow stochastics over here at default settings on the monthly chart has already bottomed and crossed above its signal line, meaning that that is bullish, that we should reach. So on a long-term trajectory, it's this information is telling me that we should be nearing a bottom and beginning to go up from here. That's on the long-term trend. Let's go down and look at the intermediate term trend, which is the weekly candlestick chart. So each one of these candlesticks represents 1 week's worth of data. The last week, the S&P lost 0.13%. You can see here in the thumbnail where we currently reside. The MACD is still above its signal line, although the histogram came down. It looks like this, if the S&P 500 can get a pop here, this will stay above the signal line, although the slow stochastics has already topped and came below its signal line. So we're getting mixed messages on the weekly time frame, kind of telling me that we might be still inbound for some sideways action for the next trading week. Until the market chooses a direction, it's going to stay sideways. That's on the intermediate time frame. Now we're going to go to the daily chart, and this is on a short-term time frame. On a short-term time frame, you can see that the MACD has bottomed, hasn't crossed above its signal line yet, but the histogram is clearly telling you that the momentum is beginning to change direction from this sideways pattern to an upward pattern. That's how I am interpreting this. On the slow stochastics, we have crossed above the signal line, but we're still below 20, so that's not exactly bullish. But if we can get a pop up above here, that's gonna bring that slow stochastics up. It's gonna bring that MACD possibly to cross above its signal line. The only thing that we don't know is how far it's gonna go. Now on this chart here, you can see that this is the purple line here, which is the 30-day moving average. The black is the 200-day moving average. Now, the fact that we are trading below the 200-day and the 200-day is sloping downward, that's all negative. Very negative for the stock market to be in this condition to begin with. Now, even though you're in that condition, I am expecting a pop. I do believe we are going to get a pop up. The only thing I don't know is how far. Now, I have a line here at 390, because that is a resistance line, an established resistance line for the market. If we can get above the 390, it's possible we'll go all the way up to around 410-ish or somewhere in there before this thing comes down. So this is called a counter trend rally and a bear market. So I'm expecting a counter trend rally to come up over the next couple of weeks. Of course, I could be wrong, but I do have an expectation that we will have somewhat of a counter trend rally, sideways action to counter trend rally. Looking at the VIX, this is the volatility index or the fear index. Now I have a line down here that tells you want to sell the S&P 500 when you're at these low readings, and you want to buy the S&P 500 when you're at these high VIX readings. And right now we're at a lower reading, comparatively speaking, compared to these higher readings. The VIX is currently at 21.67. The MACD of the VIX has come up, came down, but never crossed below its signal line. And it looks like it's starting to increase in distance between itself and the signal line. And that is actually not good for the stock market. If indeed the MACD was to continue to go up and not go below the signal line, that means that the VIX is going to go up. And the main reason why the VIX goes up is because the S&P 500 goes down. They work inversely to one another. So looking at it from the VIX's standpoint with the data that we have right now, it looks like the VIX is telling you that it's going to go higher, meaning that the stock market is going to go lower. Again, take every piece of data that you have with a grain of salt. Now we're over at the Think or Swim's trading platform. We're looking at a one-year chart for the S&P 500. The pink lines are the standard deviation -1 and +1. The gold lines are the standard deviation -2 and +2. All trading takes place between the -2 and +2 standard deviations 95% of the time. Currently, this is where we are at right now. The MACD on this chart is showing us the same MACD information where it looks like the histogram is telling you that we're going to go positive. Slow stochastics is already above its 20 line and going positive here. Let's look at it on a shorter term time frame. This is now the same thing the same graph, except it's instead of going 1 year of data, we're going back 3 months of data. Going back 3 months, you can see that we are below the -1 standard deviation, the pink line, and just above the -2 standard deviation. Although we didn't even on this washout day, we never even touched the -2 standard deviation on this chart. This sideways pattern being in this low level below the -1 standard deviation, meaning that this is like, if you look at it from the chart's perspective, this is undervalued, this is overvalued. See how we go up and then we get to this upper valued state and then come back down, come back up, kind of overvalued, move sideways, came back down. So this is telling me that we're going to go up from here. So that's what this chart is telling me. And I put in a couple of alerts to alert me that if I'm wrong, we're going to break this number here first, which is the 376.42, which is the low of this candlestick right here. And if I'm right, we're going to come up to this 390 level. So I have an alert to let me know I'm coming up. Before we break the 390, we would break this level here. So that's what this chart is telling me. So how do we play this market? I'm going to play this market the exact same way that I played it last week. Basically, I'm going to purchase another cash secured put. So this is on the Thinkorswim Trading's platform. This is for the symbol SPY, the S&P 500 ETF, with the strike price of 375. Well, why are you going with 375, Ken? Because if you look over here and you look at the 375, which is just below this low level here, I don't believe we're going to hit it. If we do hit it, that means that I was wrong in the sideways to upward trajectory and that we're going to start trailing down or coming down. But I believe 375 to be a good number for a good return on investment. So I'm looking at 2 contracts, which is 200 options, because each contract is 100 options or 100 shares, however you want to look at it. And it's actually giving us a nice yield right now of $1.39. So let me show you what that looks like on putting it into the cash secured put calculator. We put in the current stock price of the S&P 500, which is 382.43. That option of $1.39 with a put strike of 375, 200 shares. Now we cannot make this trade until 1/3/23. Well, why is that, Ken? Because there's a holiday. Monday, January 2nd is observed by the New York Stock Exchange, so trading will be closed on Monday. Can't make this trade till Tuesday. On Tuesday, we'll plug the numbers into our calculator to see how everything looks, and if it looks favorable, we will be taking this trade. It's a very short-term trade, only 3 days, because the expiration date on this is 1/6/23, just till Friday. Okay. Our portfolio is now dropping back down to $100,000 starting basis. So we are taking 75% of our portfolio and using it for this cash secured put. We're just going to have that money in reserve. We don't need to spend it, only if we are exercised. And that is the expectation there. We do have downside protection though. If indeed the market were to come down from its current level of 382, we still have a buffer of 2.31% before we're exercised. And we also, because we're getting $1.39, have a break-even cost of $373.61. We have to get below this level before we actually lose money in this trade. Now, the profit that we're going to make on this transaction is $278, and that will give us a return on the option of 0.37%. It's only a 3-day trade, folks. If we annualize that, that annualizes out to 45.27%, which if you can get 45% on an annualized basis, you are doing fantastic. So this is a conservative trade to make, not even with our whole portfolio, 75% of our portfolio. And this is the trade that I'll be looking at making on Tuesday. So that's where I stand with my positions and how everything did and how we did for the year. So you can see that for 2022, our portfolio did fantastic with a return on investment of 21%. So compared to the S&P 500 down 19%, we did fantastic. If you have not done so already, please go ahead and hit that subscribe button, ring that bell, and please click on like to help me promote this video. I thank you and wish you good trading.